Big news this morning, broken by Peter Hobson and others, writing an exclusive report for Reuters on revamping Chinese gold demand 2021. Headline reads, Chinese renew appetite for gold with 8.5 billion set to arrive as central bank relaxes quota. China's appetite for gold jewelry, bars, and coins has recovered as the economy rebounded in recent months. Around 150 metric tons of gold, worth 8.5 billion fiat Fed notes at current spot prices, are likely to be shipped by next month, 5 confirmed sources claim. China opens its border to billions of dollars of gold imports, sources. Written by Swati Verna, Zhaohan, Peter Hobson. China has given domestic and international banks permission to import large amounts of gold into the country, 5 sources familiar with the matter said, potentially helping to support global gold prices after months of declines. China is the world's biggest gold consumer, gobbling up hundreds of tons of precious metals, worth tens of billions of dollars each year, but its imports plunged as the coronavirus spread and local demand dried up. With China's economy rebounding strongly since the second half of last year, demand for gold jewelry, bars, and coins has recovered, driving domestic prices above global benchmark rates, making it profitable to import bullion. The local premium is now about 7 to 9 fiat Fed notes an ounce, according to gold traders in Asia, and that would probably have increased further if more imports to satisfy demand had not been allowed. About 150 tons of gold, worth 8.5 billion at current prices, is likely to be shipped following the green light from Beijing, 4 sources said. 2 said the gold would be shipped in April, and 2 said it would arrive over April and May. The bulk of China's gold imports typically come from Australia, South Africa, and Switzerland. The People's Bank of China, PBOC, the country's central bank, controls how much gold enters China through a system of quotas given to commercial banks that usually allows metal in, but sometimes restricts flow. We had no quotas for a while. Now we are getting them. The most since 2019, said a source at one of the banks moving gold into China. The PBOC did not respond to a request for comment. The size of the shipments signals China's dramatic return to the global bullion market. Since February 2020, the country has on average imported gold worth about 600 million a year, or roughly 10 tons, Chinese customs data shows. In 2019, its imports ran at about 3.5 billion a month, or roughly 75 tons. China's absence made little difference to gold prices early in the pandemic when Western investors, fearful of economic catastrophe, stockpiled vast amounts of the safe haven asset, pushing it to a record high of $2,072.50 an ounce. But the investor interest drifted away as vaccines and government stimulus programs revived economic growth, and gold prices have sagged to around $1,750 an ounce. India's demand for bullion has also rebounded from a pandemic-induced slump, with record-breaking imports in March of 160 tons of gold, Indian government source told Reuters this month. China and India typically account for some 2/5 of the world's annual demand for gold. Their recovery is critical in setting the floor for gold and should stop prices from falling further over the coming months, said Suki Cooper, an analyst at Standard Charter. Jewelry sales in China during the Lunar New Year holiday in February were stronger than in 2019 and 2020, and manufacturers and retailers need to replenish their stocks, said Philip Klajwich at Precious Metals Insights, a consultancy in Hong Kong. A pretty decent recovery in gold demand this year will require a generally much higher level of gold imports than in 2020, he said. A quick few charts to go through, confirming much of the gold bullishness from the article we just read. First, a bit of what was not mentioned. Current gold ETFs in China are at all-time highs, and that simply signals high interest in gold investment allocations currently. Next, you can see how pathetic Chinese gold demand has been since the Wuhan flu. The COVID pandemic lockdowns got going in early 2020. Finally, this chart illustrates 3 ongoing prices for gold in New York, internationally, and in China. When the blue line here is dominant, Western gold demand is rising. And you can see how the recent record price in gold was driven by mainly Western demand last year. And vice versa, when you see the red line clear the blue line in the chart above, likely it's China, and also probably too India, who are buying the spot price dip. After all, these two nations literally save in high-grade gold jewelry and have done so over millennia, as their state-issued currencies and regimes have come and gone, likely hundreds of times over in their respective histories. This is their gold stacking culture in price action. Hello there, on behalf of SDBullion.com, this is James Anderson bringing you this week's SD Bullion Market Update. Before we continue, smash the like button so others can get this important bullion-related information served to them as well. Subscribe to our Bullion informational video channel here if you've not done so already. The gold spot price and silver spot price both had strong weeks in trading. Let's see next week if gold can clear 1800 and the two precious metals can begin their inevitable climbs out from the 7 and 8 month consolidations they have made since early August 2020. The gold-silver ratio tightened a touch down to 68 to close the week. Karen Binford sent me the following tweet, and you silver bulls out there will perhaps also enjoy. She states that this is the most exciting chart in over 10 years. Check out the 50-week moving average death cross down over the 200-week moving average! Exclamation point, exclamation point. So let's focus in further on this chart and I can explain what she's trying to get across. Basically, when that red line passes the black line, as it did back in early 2011 for instance, well, what happened next is perhaps a rapidly lowering gold-silver ratio, as it happened in early 2011. An easier, longer-term target for this, what is likely to become a manic silver and gold bullion bull, is to see the old 2011 gold-silver ratio low of 33 get passed, as silver outperforms gold later on this decade. This week, the London Bullion Market Association, or LBMA for short, published what is likely their first ever solely focused report on silver investment demand. The report was most likely written by Metals Focus, a precious metals consultancy based in London, which often too writes for the Silver Institute's annual World Silver Survey, which is actually regularly published. This 15-page report, coming out of nowhere, appears to be an attempt to gain back some control over much of the ongoing silver squeeze narratives online. Thus far in 2021, the silver investment demand remains at all-time high levels, considering the now nearly last 5 decades of this full fiat currency era ongoing. We've never seen silver demand for investment this high. I'm going to highlight a few notes from my read of this report, so let's dig in. They begin the report by highlighting well-known, massive silver ETF demand 2020 into 2021. They first begin to legitimately acknowledge the ongoing silver squeeze on page 2, stating, turning to early 2021, the growth in silver investment demand has undoubtedly carried over from last year 2020. The much publicized social media campaigns have translated into significant gains for silver ETPs and coin demands and bars. Coin and bar demand is more difficult to judge given the ongoing and persistent weakness in India, although this has been comfortably offset by significant growth in the US, the world's largest silver coin and bar market. We've highlighted missing Indian silver bullion demand since the COVID lockdown began in early 2020. It's been so bad in terms of Indian wedding bans that jewelers late last year and the start of the year 2021 began exporting some silver from India in large volumes, perhaps for the first time, likely in search of cash liquidity to keep their businesses solvent and perhaps of late to take some advantage of rising premiums over here in the West. Here we have Metals Focus and LBMA admitting how much Indian silver demand can ramp in a short time. I maintain if and when India returns to demanding its average 170 million ounces of silver bullion per year that it bought in the 2010s, London's going to be in a real trouble servicing that demand without a rapidly escalating silver spot price. Lots of assumptions are made in this report about the typical silver investment demand buyer profile. Most retail bullion buyers, they claim, are not driven by the silver squeeze, more so by the ongoing Biden administration's stimulus ramps ongoing. While this is likely true in the newbie crowd, the writers of this report totally underestimate the stubbornness of silver bullion stackers and silver investment bulls. In my experience, they'll wait and add to positions over many years, even decades, for their investment theses to play out. Once they've taken the red pill, basically, in buying silver, there is often next to no turning back. Looking at some of the statements made here, for instance, they say in early February, when the underperforming shares of SLV had record inflows, fears emerged in London as to whether there was enough silver which could meet demand if it continued at that pace. Now perhaps this is code for SLV and SIVR prospectuses got changed and updated with loopholes, which basically allowed them to not meet outsized silver investment demand in their ETFs. Further down, the authors incorrectly presuppose that there may be no repeat of the social media frenzy. That's incorrect, and let's check back in when silver spot price goes to the mid-30s, into the 40s, and eventually beyond its seemingly ancient record nominal price high of 50 fiat Fed notes per troy ounce. My suggestion is it's going to be much louder and much more rapid. I don't think these people really understand what's coming and what's been building for decades. They write, should that occur, higher prices would almost certainly be triggering heavy selling. Now, perhaps in unsecured derivatives, there will be profit taking along the way, but most silver bullion buyers have triple digits and often never selling in their mind. So good luck getting much of that silver bullion back into the silver float supply anytime soon. Later in this report, we get an admittance that allegedly 103.2 million ounces of JP Morgan Comex warehouse pile is fully allocated to the iShares SLV they are the custodian for. And that's alleged to have been the case since 2019. So in other words, according to them, Metals Focus and LBMA, which approved this report, 55% of this dominant Comex silver fractional reserve pile is SLV allocated. Looking back at JP Morgan's customer versus house percentages over the 2010s, this breakdown jives, which is also somewhat interesting. It just goes to show you how insidious and perverse this Comex silver and unsecured silver ETF market truly is. Why would anyone trust any of these people or institutions with their capital giving their terrible track records? Next, in the LBMA Metals Focus report, they claim that silver squeeze social media chatter has died down. Meanwhile, the Reddit subforum is closing in on 60,000 members within about 75 days of existence. So that's untrue. Perhaps the energy in the chatter has been moving sideways, but the amount of people has been growing every week. Retail silver bullion demand reflects the rabid nature of these new silver bullion stackers. It is still very high. Here was an interesting insight into Indian silver investment demand, I thought. Remember how I told you in the 2010s the Indian nation on average imported about 170 million silver ounces per year? Most assume it is all for mere poor Indian jewelry demand, but that's not so according to Metals Focus. They state the following about Indian silver bullion stacker profiles. During 2018-19, India occupied top spot with retail investment in each year exceeding 50 million ounces. However, these pale against its performance during 2014 and 15 when Indian silver bar and coin demand surpassed 100 million ounces. In general, Indian demand has typically benefited from strong silver price expectations, with many viewing silver as being undervalued. This has often led to a surge in investment when prices have fallen. In addition, the past few years have seen a gradual shift away from gold and in favor of silver as the Indian government has clamped down on unallocated money. Drilling down further, there are broadly three types of customers who buy silver in India. First, there are high net worth individuals who tend to purchase large silver bars such as 5 kg, 15 kg, and 30 kg bars. Second, there's a large section of consumers and investors who buy small minted bars with inscriptions and images of gods and goddesses. These bars are either bought for investments, gifting, or for rituals. Finally, there are small investors who buy 500-gram, 1-kilogram cast bars. Last year, India was the only key retail investment market to see weaker demand, a combination of the pandemic, which hit disposable incomes, and record-high rupee silver prices, which saw liquidations emerge, a trend that has carried over into 2021. What happens when Indian gold and silver prices start a new bull climb in the coming years? This, to me, seems to be the calm before the raging Indian silver bullion demand storm, in my view, but this report has no take on that question. Basically, what happens when gold gets too expensive for the average man on the street and they go after the poor man's gold buyer goes after silver in earnest. Now back to ongoing record silver-sized Western silver investment demand ongoing. Last February freaked London out, and the report states multiple times concerns that if demand had kept near that pace, it would have only been a matter of weeks before London's existing stock was used up. My astute industry colleague and precious metals analyst at Singapore's Bullion Star, Mr. Ronan Manley, this week, he pointed out in his article covering this London admittance to how severe things are getting in the silver market by pointing out many things they did not cover, like the outsized massive amounts of unallocated silver accounts yet to be rectified. And no, we're not talking about small fry unallocated accounts down under in Australia or allegedly up north of the border, catching heat from their worried customer bases. No, what Ronan, and now I, am referring to is the massive unallocated accounts still held at many commercial banks in London, within the EU, and over in Asia as well. We've yet to see those customer bases react to the poor, inferior, unsecured derivative products they have mistakenly chosen as precious metal proxies. What happens when these accounts wake up and demand bullion allocated to them directly? To conclude this week's update, the East is fully returning to the gold market now. It's only a matter of time before that bleeds over into acutely increased Eastern silver bullion demand too. London appears wholly unprepared for what's building. Perhaps the one thing that will save them are rapidly rising spot prices in fiat currency terms. Judging by where the current trade-weighted fiat Federal Reserve note is versus all other fiat currencies based on trade weightings, similar to the gold-silver ratio we looked at earlier in this update, we here also have a long way to run lower before we get back and likely beyond the 2011 low levels seen here. Get long and well-positioned silver and gold bullion before it becomes super obvious to those still distracted by silly bubbles outside the bullion markets. They will be the ones who pay you handsomely for doing so later and at way higher valuation levels. That's it for this week's update. As always, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.